I'm Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Wednesday, January 10th, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for the market ahead. Well, as we look at futures, at least as of about 10 minutes ago, we got futures down just slightly. Dow futures down 8, S&P 500 futures down 2, NASDAQ futures down about 12. So on a percentage basis, they're all down less than 0.1%. Crude oil prices up a buck to 73.24, so that's up a little over 1%. And the U.S. 10-year Treasury yield down almost 3 basis points back to 3.99%. And that's important because that's threatening to break down below the 20-day moving average after being above it the last couple of days. Now, before we get too excited, I can tell you we got a big economic report coming out tomorrow. That will be the December CPI. And then on Friday, we have the December PPI. So as we look at the interest rates and so forth, just realize that could change based on the data we get over the next couple of days. But still, nonetheless, we do have the 10-year Treasury yield moving back down. If that number is tame tomorrow on the CPI, and let's see what we're expecting. I'll tell you what the folks on Wall Street are looking for. We're looking for a headline jump of 0.2%. And if we exclude food and energy, so we look at the core number, we're also looking at 0.2%. We're looking for, at the core level, the annual rate to drop from 4% to 3.8%. So crawling closer and closer to that 2% target that the Fed has set. If the numbers come in better than that, if the CPI at the core level is beneath 0.2%, I would expect that we will see similar to what we've seen over the past few months, which would be another rally. If we come up with the CPE at the core level jumping more than 0.2%, then I would think maybe we'll have a challenge on our hands trying to hold some key support levels. And especially on the Russell 2000, we've been in this trading range between about 192.67, which is gap support, and then a little bit above 196.15, I think, which is the top of gap support. The 192.67 is the bottom of gap support. So we're in that range right now. And I do think that whatever kind of message we get, maybe we get 0.3, maybe we break down intraday and then the market, rallies back. I mean, we've seen that quite a bit over the past couple of weeks, the IWM in particular. I think I looked at one point yesterday before I sent out the daily market report to our members. And since December 27th, the close, we were at 204 and change on the IWM. And when I sent out the DMR yesterday, I think we were around 195 or maybe a little above 195. So we were down about $9, a little over $9, I believe. And the opening gaps had accounted for 8 something, close to $9. So it's almost like the entire sell-off at this point has been directed by market makers, which I believe is just a lot of manipulation. As I've said before, your professional investors don't put market orders in at the opening bell. That's not how they get out. It requires actual selling during the day. You've got to sell those shares to someone. And after hours, if you're trying to unload millions and millions of shares, you're not going to do it in after hours trading. There's not enough liquidity. There's not enough willing buyers. And the impact that selling that number of shares in after hours because of the lack of liquidity would be pretty catastrophic. So we need to see selling during the day. If you're going to convince me that this market's going lower, can't be dropping via gaps. It needs to be much more than that. Last couple of days in particular, we've seen gap downs and we've seen buying throughout much of the rest of the day. And that to me is a sign of accumulation, not distribution. So anyway, that's kind of how we're starting today, kind of looking at some of the economic reports that are coming up, and then talking a little bit about the IWM. But let's go ahead and take a look at the action from yesterday. And I got a lot I want to try and pack into today's session, so I'm going to try and go through this a little quicker if I can. Dow Jones Industrial Average yesterday down 158 points. That was down 0.42%. S&P 500 down 7. That was down a little bit more than 0.1%. The NASDAQ 100, the NDX gained 28 points. So that was up almost 0.2%. Mid caps and small caps, though, again, taking the brunt of the selling, but again, most of it coming at the opening bell. We actually finished above the big drop at the open on Tuesday, same as Monday. And then we came rallying back, but still did finish down on the day. Mid caps down 0.6%. The small cap IWM down about 0.9%. Transports down almost 0.9% as well, but coming up off the earlier lows and still holding on at around that 15.4, 15.5 area. So I would continue to watch that as a key support level in the short term for transports. Moving on to the sectors, we had staples leading 0.25%. If you're a little concerned about that, don't be too concerned for long, because right behind was technology, gaining about, a little less than 0.2%. And then healthcare flat. Those were your three best sectors. Little mixture. You got clearly a defensive group in staples, clearly an aggressive group in technology, and then probably a more defensive than an aggressive group in healthcare. But healthcare has areas of aggressiveness, namely biotechs, which have been on absolute fire. If you've been watching biotechs over the last couple of months, that's part of what's helped the IWM and small caps. There are a lot of small cap biotech names, a lot of small cap healthcare in general in the IWM. So getting a lift there for sure from the XLV. Looking at the industry groups, these were three industry groups that all managed to climb more than 1%. Most of the gains yesterday among industry groups was less than 1% or in negative territory. But here were the three of the outliers. We had durable household products gaining 1.25%, moving up, trying to break out above about the 152, 153 area. Finished back above 150. That'll be worth watching. Broadline retail bouncing just from beneath the 20-day moving average, moving back up near recent highs, gaining 1.27% yesterday. And then finally, the vintners and distillers up 1.08%. So again, just a little bit above that 1% level. But this is a group that had been beaten down quite a bit and really hadn't recovered in the fourth quarter, like much of the overall market. It looks to me like it's just making a breakout. So, stocks like Constellation Brands, STZ, names in that area could be worth taking a look at in the short term, especially if we keep getting this choppiness in the market. This could set up pretty nicely for a group in the defensive area that's just now making a key multi-month breakout. So wouldn't shy away from that group. It's not going to give you exciting, heart-pumping kind of gains, but probably isn't going to give you nearly as much heartache to the downside either. And the fact that we've broken out, we're now trending above the 20, which is above the 50. I think this sets up pretty nicely going forward. 10-year Treasury yield, let's get the latest here. Still sitting down at 3.992. The 20-day is right on 4%. We have traded the last 3 days above the 20-day moving average on the 10-year yield. And today it looks like we're trying to go back just below it. But again, two key economic reports coming out on Thursday and Friday. Both of the key inflation reports, the Consumer Price Index, CPI, and the Producer Price Index, PPI, will be out the next 2 days. And they definitely have market moving capability. So at the close today, if you're a little nervous because the market hasn't been doing, hasn't been great, it's been more sideways, even though we did see some strength yesterday. Maybe it's you sit on a little bit more cash than usual. I don't know, whatever's better for you. I'm going to go ahead and stick with my investments. I believe the IWM is going higher, especially with most of this selling over the course of the last week or two being mostly the gap downs. That just reeks to me of accumulation. And I do think if we get a lower than expected CPI report tomorrow, we could see the opposite. We could see a gap up and then back up to that 205 area on the IWM. So it depends on how much risk you're willing to take. There is a lot of risk going into the close tonight. Between the close tonight and the open tomorrow, we could see the markets up a couple percent. We could see them down a couple percent. However, if you want to stay long, maybe have a put just in case the market goes down. That way you protect yourself a little bit to the downside. It's a little bit of insurance. If you go to the upside, you're going to probably lose whatever you put into the option. But again, totally up to you. Let's keep moving. The S&P 500. The most recent high here, we had a slight negative divergence, very slight on this high. Overall, the move up was accompanied by higher PPO. Here we've gone down, we've tested the 20-day, and we're bouncing, but we're not getting much of a move back up in the PPI. So if we do get back up to 4,800 on the S&P 500, that might be about as far as we go. Remember, we've got January 18th approaching, only 8 days away, so it's a week from tomorrow. And that's when the historical bullish period that began back on October 27th at the close, this whole move up right here, this has come during the most bullish period of the year, going back to 1950. But this period ends a week from tomorrow. So if we do, kind of stagger up here a little bit more and get close to that 4,800, maybe even close at an all-time high, it's probably going to occur with a not so good looking divergence in play. So I actually think when earnings start coming out, we may see a little bit of selling, a little bit more than normal, which I'm not going to rule out the possibility of 4,550 to 4,600 to the downside. Just the way the daily chart's looking. Now, keep in mind, if I pull up this weekly chart, you're going to see a little bit different picture here. Center line reset here, just a little bit below the 50-week moving average. And we're going straight up, and that PPO couldn't look much better. Now, I know some of you might say, well, whoa. Higher prices, lower PPO, negative divergence on the weekly charts. It's not the way I read these charts. I've been doing this for a long time. Anytime I get the 50-period test and I get a center line test, it's like we got a whole new ball game. I ignore everything left on the PPO. I don't care where the PPO was before because we had no momentum when we got to zero. There's no momentum. How can you have slowing momentum when it goes back up when you had no momentum at zero? The zero line means your short-term moving average and long-term moving average are the same. There's no momentum in the market. So there's a reset. Otherwise, every time the market went up, this is kind of the example that I like to use when someone says, well, there is no such thing as a reset or whatever. Let me show you a chart. Let's take a look at the 30-year monthly chart on the NASDAQ. Look at where the PPO was back in 2000. We had a monthly PPO at 30. We would be looking at this still today saying every high, there's a negative divergence. And technically, that's textbook. There's a peak. There's your PPO. Every peak since then, every time we've broken out, we've had lower PPOs. So I guess my question to you is, when does it end? When do we not, at what point do we not consider the past? I say it's when we get a center line. I say it was right here when we got back down to the zero line. Momentum is erased. So personally, that's what I would use when I'm looking at the S&P on the weekly. Anytime you get to the center line, it's over as far as I'm concerned. And we start new. So here on the weekly chart, I'm seeing bullish momentum. I'm seeing prices going up, and I'm seeing the PPO moving higher. So on this particular chart, what I would be looking for with a strong PPO is a 20-period test. Well, look where the 20-period is on the weekly. 45.40. And if we go back to the daily, that 50-day is at 45.63. So they're almost at the same spot. So if we get this negative divergence that pops up, I'm just throwing it out there because I do think the first quarter is going to be choppy. That's kind of one of the things that is a little bit of a hallmark of a election year. I talked about this at Market Vision 2024. But the first quarter tends to be not so great, even though the first quarter tends to be okay since 1950 on the S&P 500. One thing that seems to be kind of attaches itself to an election year is that we usually start off the year a little tepid. And so it's kind of what I'm expecting here in the short term. So yeah, we could go back up to 4,800, maybe even slightly above, maybe set an all-time high close. And then just when everybody starts to say, okay, the coast is clear, that's where I think the rug could get pulled in the near term. And I'm not talking about a 20% bear market. I'm not talking even about a 10% correction, but I wouldn't be surprised to see maybe 5%. And from 4,800, that would take us down 240 points, which would be at 45.60. Again, right about at the level where we would expect in terms of moving averages to reset. So just something to think about. The NASDAQ, NASDAQ 100, probably the same thing. I mean, PPO is flattening as we roll back to the upside. I think that could be a problem if we get back up to 17,000 or just above. So let's say we get a couple of good CPI and PPI reports the next couple of days. That could be something that sparks a continuing rally back up near the recent highs. We go into next week, January 18th, which is next Thursday. That ends the bullish period historically. We have negative divergences. We're going to be in option expiration week. I mean, there could be some things that could really send us back down, after the 18th and maybe for a week, 10 days, something like that is what I would expect. Anyway, IWM. Now this daily chart looks much better. Straight up, PPO still looks good. We have pulled back a lot, but let's see what happens to the PPO if we do move back up to that 205 level and challenge. First thing we need to do is get above the Monday high. So if we can get through about 197, 197.50, I think that's setting up for a trip to 205. If we fail on this period of consolidation and lose the 192.67 level on the close, then I think we're setting up potentially more for, a 50-day test, maybe down somewhere in that 184, 186 range. That's the way I'm looking at the IWM at this point. Transports, same as kind of the Russell 2000. Moving up looks pretty strong on the PPO, but we're now down below the 20-day. We need to get back through about 15.7. If not, we lose 15.4. Then I think we're probably going to lose another 1.5% to go down and test a key neckline support level closer to 15.2, which is right near that 50-day moving average. All right, EarningsBeats. Over at EarningsBeats, if you go there, you can start a 30-day free trial by clicking on that Start Your No-Cost Trial button. We do have our trading room, our live trading room today. It starts at 10 a.m. Would love to have you all join. If you're not part of that, you're missing out on what typically is not only a solid review of maybe some trading strategies and possibly some actual trades, but also a look at a lot of educational stuff. Things the way I set up my trading strategies, the way I look at the market, how I view rotation and what that could mean. Just like when I was looking at the distillers and vintners over at at the open of the show, seeing how that group's just now breaking out, that would be an area maybe to look at for possible trades short term. And I wouldn't feel as compelled to have to watch it every 30 minutes or even 10 minutes throughout the trading day. I think this is a group that moves a little slower, that probably you could maybe step away from your trading a little while and still feel okay. But anyway, that's one way to hook up with us. Go right through that no-cost trial, 30 days for free. You'll get the next 5 live trading rooms. We have them every Wednesday morning. So you'll get 5 trading rooms for free during your trial period. Anyhow, you can also go down, subscribe to our free EarningsBeats Digest newsletter, where we do send out a digest chart 3 times a week, Monday, Wednesday, Friday. All it takes is a name and an email address. Hit that subscribe button. You're good to go. You can unsubscribe at any time. It is free, and there is no credit card required. So this is our free newsletter that goes out to our community. Folks want to kind of get used to us, maybe just want some ideas. And then when you're comfortable, if you can take that plunge, we'd love to have you in our paid service over at EarningsBeats. That's what helps us do all of what we're doing, by the way. So today we did something a little different. This came right out of our January Effect webinars or Market Vision series that we did. So we had two events that led up to Market Vision 2024, and this was the second one. It was what we look at with the January Effect is what happens during the month of January generally triggers whatever's going to happen the balance of the year. That's what the January Effect tells us. The old Wall Street adage is as goes January, so goes the year. And so what we did here is we put together slides on the S&P, NASDAQ, and Russell 2000 showing you 4 quartiles, 1, 2, 3, 4 on each of these major indices. And we broke down January performance into the top Januaries, top 25% of Januaries since 1950. So there's 74 years. So there's going to be 19 Januaries in 2 quartiles, and there'll be 18 Januaries in the other 2 quartiles, but we've ranked them. And so the top, I think it was the top 19 Januaries, averaged going up 7%. That was the average January performance. The balance of the year, not including January, starting all over again on February 1st, balance of the year, that's what this BOY is. Balance of year goes up another 15% on top of the 7%. And this 15% is calculated on the January close, which is higher than the December close. So this number actually would be a little higher if we took the gain from February to December and divided it by the December 31st balance. If that's our numerator, this 15% probably goes up a little bit more, maybe to 15.5% or 16%. Anyway, the point here is that when you have a strong January, the average of those years shows a lot more strength balance of the year. The second quartile, where the S&P 500 January performance averaged 3%, goes up another 10% balance of the year. So you can see if you're in the top half of January's, you've got odds of continuing to move higher balance of the year. Now look what happens when you get into the third quartile of January's and then into the bottom of January's. Look at the balance of year return. That average comes down a ton. So that's all we're talking about here in terms of January Effect is, my personal belief, you might say, well, this makes no sense. If January goes up, the rest of the year shouldn't be as strong. Well, the way I look at it is these big Wall Street firms hire the sharpest people from all these Ivy League schools. You might hear me talk, badly about some of these big firms because I do think they take advantage of individual investors, and I don't think that's a good thing. So if you think that's me overreacting, then fine. But I don't like these Wall Street firms that take advantage of retail traders. But what I'll never say about these firms is that they're dumb. They are brilliant. I mean, if you take a look at the folks that are in Goldman Sachs and Morgan Stanley, and I mean, we're talking about the most educated people in the U.S., some of them anyway. I mean, obviously, you got a lot of educated folks going into other fields, but I mean, we're talking about really, really sharp people in the financial area that are working for these companies. And I mean, when you've got some of the top economists on your staff, you don't think at the beginning of the year you can make a projection for what you think is going to happen for the year? I think some of them are excellent at it. That's where I think the benefit of January comes in. Because if they believe it's going to be a strong year, what do you think they're telling their division that handles, all of their trading and investing for institutional clients and pension funds? What do you think they're doing in January? They're buying. And if most of the time, if the balance of the year turns out the way they think it's going to, then this is the result you're going to get. So anyway, I find it, I think there's something to it. Now, as you look at the NASDAQ, you can see these are the Januaries going down in performance. We do go down in performance each quartile, but not much. The first quartile to the third quartile of January's, the balance of the year comes down a little bit, but not a whole lot. So I don't really see a lot in terms of balance of year performance. I don't know why it would be, why it wouldn't be similar to what we see with the S&P 500, but it isn't. These are the numbers. These are the facts. The fourth quartile, however, if you're in that bottom January on the NASDAQ, chances are you shouldn't be looking for a whole lot. Your expectation for the balance of the year should come down quite a bit. Now, the Russell seems not matter what January you do in January, what kind of a January you have. Balance of the year definitely seems to be a little higher in the first quartile, but 2, 3, and 4 are all pretty decent. So I just don't think we're getting the same signal there. But S&P 500 is what I rely on. This is the one that has been just eerily accurate over the last 74 years. And so where are we on January 31st at the close? Once you figure that out and you plot which quartile you go in, you have a little bit of a clue. I'm not saying you have a guarantee. If January goes up, more than 4 or 4.5%, that will put it in the number one quartile. I'm not going to say, hey, you're going to get another 15%. This is an average. We had some down years. I think there were 2 out of the 19 years where the balance of the year was negative, because I think things can change in the market during the year. And these big Wall Street firms aren't going to get it right all the time. But I do think that there is substance to what happens in January. So we'll revisit this. I'm sure we'll probably do some kind of a webinar later this month or early February as well to go over and talk about some of this. All right, let's keep moving here. I wanted to talk about the VIX. I said yesterday I'd pull up a chart on the VIX, and I never got to it. We just ran out of time. So I wanted to do that today. And you can see what I did. And I'm going to show you this chart or this article, and I'll come back to it. But this was an article on January 6, 2023, where I talked about the VIX and the correlation to the S&P 500. And when it goes positive, a lot of times it's signaling that the market is about to change directions. So the S&P was under pressure to the downside. We rallied. But during the fourth quarter of 2022, we pulled back on the S&P. And you can see overall, we actually moved higher on the VIX. And at the very, very end here, actually, I guess it was more like just before the end of the year, you can see that the S&P went down for probably a week and a half, and the VIX went down with it. And that's unusual. And that's what triggered this quick move into positive territory. Now, the problem I have is that when you do move into positive territory in terms of correlation, look at what's happened in the past. This is where we went positive in September of 2020. Market was going up, and we actually started to see the VIX going up, which is really weird. So as we're going up, we're getting more and more fearful. That's not a good thing, because then if something goes wrong, the market's already nervous. So here, when we topped at the beginning of September, and what went wrong was September. I mean, September is generally not a very good month. But anyway, that was a signal that this could reverse, that the odds of a reversal were growing. Look what happened. Here, as we went positive in the middle part of November, we had been going up, and we saw the VIX start going up. Positive correlation. What happened? It moved down 200 points on the S&P, maybe a little bit more. I mean, that was close to 5%, a 4 or 5% move down in 2 or 3 weeks. And then here, I was writing this article saying, okay, here it is again. We were moving lower. The VIX was moving lower. We go positive correlation. And because we had been going lower on the S&P, we were looking for a rally. So I just said, hey, we could soar in the short term. Now, if we pull this chart up, after December, here was our correlation right there. Look what happened. Now you know why I was calling for January to move higher. I mean, already I'd been calling a bottom in the market. So this was just one more piece that was telling me, hey, this ain't going to last. I mean, we're going down, and we've had the VIX moving along with it. Usually when the market goes down, we're starting to see more and more fear creep into the VIX. Instead, the market was going down and the fear was leaving the market. I mean, the way the VIX acts is kind of like, this is based on premium, short-term option premiums, which tells me that the VIX is more a look at what market makers are thinking about the overall market. And here you can see the market makers were not worried. They were pricing options lower, even though prices were going down, which is unusual. And as it turns out, the reason was because the market wasn't going to keep going down. Market reversed and went back to the upside right here in January 2023. So going back to this VIX indicator, the other thing I wanted to talk about with the VIX was, depending on where the VIX is, look at the performance of the S&P 500. Very, very bearish if we're over 20. S&P 500 annualized return on all of these days is minus 37%. When you are closing over 20 on the VIX, it's not good. It's not good for you. You need to be really careful. When you're in the 17 to 20 range, we're okay, maybe a little bit better than normal. You go down below 17 and you can see that annualized return really pick up. And when we're below 13, that's when the S&P 500 does the best of all. When we're sitting down here, I love it when I hear bears talk about a low VIX. It's like, okay, what's your point? This is the actual performance when the VIX is low. Where you really start to run into problems is when the VIX is over 20. So talk to me when we're over 20. Until then, I think the VIX favors the bulls. And this is, I mean, how can you argue with numbers? This is the way it is actually traded over the past 11 or 12 years. This goes back, I think, since the beginning of the secular bull market. So pretty interesting chart, in my opinion, and one that, you want to keep track of, because where did we finish on the VIX yesterday? $12 or 12.76. And so 12.76 is below 13. We are in that zone where the S&P 500 does its best. It does its best work. Anyhow, a couple of things. I wanted to show you 3 charts, and then we're going to wrap up. Upwork. This is one I've been talking about. I wrote an article about it over at Stock Charts. I also posted it for our members. It's also in one of our portfolios. This level right here at 1565 or so, if we get a meaningful breakout, yesterday we had kind of a reversing candle. I don't like that false breakout short term, but I think we're going to come back up and break out. I just don't know when it'll be. I think the odds, usually when you get a false breakout like that, the odds are that normally you'll see a little bit more weakness before you see more strength. And we are after 9:30, so let's get an update on this chart and see where we are. And there you have it. You have a little bit more weakness. We got down to 1492 from yesterday's close, which was 1523. So anytime I see that, I expect I'm probably going to get an opportunity. Maybe this somewhere in this gap support. I would think 1470 to 15 is a pretty good area to re-enter. Upwork, where I think it's going to make a push back to the upside. Next up, Zoom. Look at the tops on Zoom at 74, 74 and a half, probably about 74 and a half. If we get a definitive breakout above 75 on Zoom, I think that would be an incredibly bullish sign. Here, I always like it when you get false breakdowns just slightly below the prior low. Many times that's a major low. Now, there's no denying right now that we are in sideways consolidation after a downtrend. So for those bears who look at this chart and say it's a bear flag, I can't disagree with you. So there is definitely risk. Maybe you follow the 50-day as your stop. We did go up slightly here in December, and we don't show the PPO, but I know the PPO was negative. And we went right back to the 50-day center line test, or close to it, I think, on the PPO on Zoom. And I think this is an area where we can resume back to the upside on Zoom. But I will acknowledge that this is a bearish looking chart. I just think it's in the process of turning. I like the AD line coming off of this bottom right here. And even with this selling, we really aren't dropping much on that AD line. I think things are just setting up for Zoom. So let's see. I have no idea what's going on so far today. Zoom is down 18 cents. But again, I would be watching to see if we can get through. First test would be that 20-day, but really the big one. I mean, when you've got 5 or 6 different tests over 8 or 10 months at the same level, that is a really, really important resistance level on Zoom. So keep that in mind. The last thing I'll mention is that on Friday, earnings season gets kicked off with a lot of the large banks. JP Morgan is the headliner. I can tell you what, they're going to have blowout numbers. You don't have a chart like this heading into earnings without blowout numbers. Now, has it moved too far? Will it be a buy on rumor, sell on news? That's very possible. But the odds of them disappointing when they report are, I would say, between 0 and slim just left town. I mean, I don't see it. I think this is going to be a blowout. I think this could be one of the best earnings reports of the quarter based on how JP Morgan's been trading. I mean, banks have been pretty strong, but JP Morgan is just knocking it out of the park. You can see we had a big rally back into October on a relative basis. And with this last big push, you're seeing the relative strength pick back up again. We'll see. I mean, there's banks. Banks have really been moving higher of late. I really like banks in 2024. I think this is something that could continue throughout the year. And so I think that bodes well for not only JP Morgan, but a lot of banks. But anyway, we got a lot of reports in the banking area that come out starting on Friday. So be aware of that. All right, let's check, see what's going on. We're going to have our trading show starting, our trading room starting in 24 minutes. So I'm going to get going. We do have the market rebounding, though, a little bit. We've got the Dow up. NASDAQ up about 0.3%. So rallying, which is good news, continuing what looked like an uptrend that was starting with yesterday's action. So beautiful action on, to start the day. Could be better, but certainly could be a lot worse. And look at that VIX now down to 1270. Still hunkering down below that 13 level. Folks, I've done the research. Low VIX is a great sign for stocks. Doesn't mean we're going to just rip the cover off the ball to the upside, but I cannot get behind any kind of a major drop in the market when you've got the VIX sitting down below 13 right now. Anyway, that's it for me. Have a great day, everybody. And again, come over and join us at EarningsBeats for the trading room. Love to have you. Go to EarningsBeats.com and sign up for the 30-day free trial. It does require a credit card, but we'll let you know at the end of your trial period that your trial is coming up and that you're going to get charged if you don't either move to an annual or if you don't cancel, you'll get charged our regular monthly rate, but we'll let you know. We don't want you to be part of our service if it's not for you. But I think a lot of people are really happy they've had us these past few years with the crazy volatility. We've been nailing it left and right. Would love to have you come on board, and please join us for today's trading room. Would love to have it. Also, again, like our video and subscribe to our channel. That really helps us with the algorithms on YouTube. So we'd love to really build our community in 2024. And that's another way you can help us. Have a great day, everybody. Happy trading. See you tomorrow.